With a hawkish Fed and global recession seemingly on the horizon, are we in the midst of the sum of all fears for financial markets, or is it maybe not quite so bad, or at least not quite yet so ominous? Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive, and we are going to explore where last week's price action leaves us after that very interesting back-to-back from earnings that NVIDIA reported. Again, very impressive earnings. And then the Jackson Hole Symposium, which apparently gave us all of the market reaction a day before the speech from Jay Powell that everybody was so focused on actually occurred. So, what is actually happening here? How are we set up, and how will this narrative play out for us for the rest of this week? Let's have a look. We begin with just a review of the price action first and foremost. And what we see here is an interesting sort of narrative. So what I've done is I've put together some weekly charts for the key benchmark assets so that we can run through and see if there is some sort of connective tissue, some sort of a narrative that presents itself. This right here is the 2-year note. You can see here, strong down move last week, highlighted there in the yellow. That points to higher interest rates at the front end of the yield curve, so higher short-term interest rates. Ostensibly, that seems to speak to the expectation coming out of Jackson Hole, not surprisingly, that the Fed is likely to hold interest rates higher for longer and may even raise rates again before the year is out. But then we go look at the long end of the yield curve, and it's a different story. Here, bonds actually closed up on the week, longer interest rates, then lower. And so what we see here is ostensibly a rise in rates when we're talking about the shorter term, a decline in rates when we're talking about the longer term, so a flatter yield curve. And perhaps the expectation that holding rates higher now comes at the cost of needing to cut them more so later. This gets to be more interesting still. The dollar, stronger for a 5th consecutive week, and here we're looking at it against the euro. So when you see that red candle go down, that's the euro falling and the dollar strengthening. These are 6E euro futures, and we're looking at the euro because, of course, it is by far the most liquid counterpart to the US dollar, by far its most liquid expression, and so captured in here is most of the average direction of the dollar against its major counterparts. And we can see here clearly another strong week that might comport, one would think, at the very least, with shorter term interest rates going higher. But then gold went up, which is another strange outcome when you consider that gold typically operates as a foil to the dollar, being a sort of physical alternative to paper currency, a kind of store of physical value versus a store of value based on government say-so, if you will, or fiat. And on the other hand, gold is a function of yields because gold itself, of course, doesn't confer any yield at all. So when interest rates go up, that makes gold typically less attractive rather than more. Because, of course, why would you own an asset that yields nothing when you could own an asset that is rising that does yield something? So when interest rates go up, that tends to be bad for gold. Yet here it is higher. Looking at what equities made of this strange stew, here's the Nasdaq here, which, of course, has been the quintessential or the S&P, rather. Here's the Nasdaq. And you can see here, obviously, tech has been a key catalyst for the markets, and the Nasdaq is the most sort of potent expression of that. It's an index where tech is an outsized contribution, even by its own outsized contribution to the market itself. Tech, obviously, the biggest market caps across the U.S. equity space are now in the equity space, or in the tech space rather. And so, what you see here is a kind of loss of conviction, an attempt to really mount a more spirited rally after 3 weeks of intense selling, and then having that rally fizzle. That's the weekly candle there. And you can see we attempted to go so far as to erase all of last week's and the prior week's decline, and then gave it all back. So the narrative seemingly that we have a situation where even blockbuster earnings for the second consecutive quarter from the AI darling of the tech space, so the best story inside the best performing sector, inside a still resilient U.S. stock market, even that is unable to sustain upward momentum. And of course, we're talking here about NVIDIA, the maker of GPUs and all kinds of other constellation products and services around the emerging artificial intelligence or AI revolution that has so captured the market's imagination. And once again, here's the S&P. Again, you can see the primacy of tech because this looks almost identical to what we just saw in the Nasdaq as far as weekly performance, an attempt to erase all of last week's sell-off, or the preceding week's sell-off, I should say. Again, a full folding of that effort by the time we got into the end of the week. So how does this come together and how does this comport? Well, if stocks don't want to go up and don't have the confidence to go up, at the same time that gold doesn't want to go down, and at the same time that long-term interest rates manage to stay down and bonds actually rise, even though at the front end yields are going higher or shorter term paper is falling, we start to see perhaps not just speculation that the Fed could hold interest rates at the shorter end or at the nearer term higher for longer, but that the market is starting to come to grips with what the implications of that are. So if the market is beginning to become concerned about growth, if it's beginning to become concerned that there is recession looming on the horizon, you would see higher rates at the front end reflecting the shifting outlook for Fed policy if the markets are readjusting to a more hawkish Fed, and indeed they are. The likelihood of a rate hike, as we'll see here momentarily, has increased. In fact, we'll jump a bit ahead here. You can see the probability of a rate hike before year end here now at 65%. That's that November number there. You can see it peaks there in the number hikes cuts column, and you can see in the percent hike cut column, which is the likelihood of a move at that given meeting, as opposed to the cumulative likelihood, that more likely than not, the markets expect to see that hike in November rather than September, about a 22% chance of a hike in September, and a 43% a chance, a little bit over, of a hike in November. That contrasts with a mere 20% chance of a hike through the rest of the year at the beginning of this month. So that, of course, would comport with an upshift in front-end rates and the decline in the two-year note, but it might also comport with expectations that this is now going to kick out the last leg of the global growth stool that's still standing. We, of course, got yet more evidence last week that the situation in the Eurozone looks like recession, and economic data out of China has been nothing short of awful, signaling that that economy still can't get up off the mat since reopening from COVID restrictions back in December. That leaves just the U.S. of the three main engines of global growth still standing. And if the Fed is going to take square aim at that pocket of resilience and try to knock it over, well, then a global recession with all of its consequences might well be now the baseline for where we're headed. And of course, in that kind of a defensive market, you would expect that you have capital flowing to longer term bonds where volatility is less and sensitivity to short-term interest rates is less for a degree of haven and to express the desire for liquidity and the desire for some sort of exposure to what would ostensibly over a longer term become an easing cycle to respond to that recession. That would also comport with a stronger dollar, which is by far the most liquid of the major currencies. If we take a look at the numbers out of the Bank of International Settlements, which keeps score on these things, still, by their latest stats, this is for enthusiasts of de-dollarization, 88% of all monetary transactions as of the BIS's last reckoning were settled ultimately in the US dollar. 88%. So this notion that the US dollar is somehow fading out of use is just nonsensical. And so what you see here is a stronger dollar, perhaps because you're getting a bit more of a lift from the front end of the curve because you're expecting that maybe the Fed is going to do one more hike. But more importantly, perhaps, the way that this comports with everything else that you're seeing at the long end is that the dollar is finding a degree of haven demand as stocks decline, capital cashes out, and of course it cashes out into the most liquid of currencies because, again, that's where volatility is likely to be least. Looking at gold then, perhaps this is why it too has held up. Because in this kind of an environment, you might expect that gold looks like a better store of value with the expectation that rates will fall in the future. Markets are as ever forward-looking. And so if you were sitting here last year watching interest rates go up all across the curve because the Fed is actively hiking, well, then gold falls with stocks. Not much of a safe haven, really, but certainly a creature of yields. Where in this environment, where the yield curve starts to flatten, and there is now an expectation that maybe there's a little bit more tightening now, but the trajectory going forward for a store of value kind of asset is for the onset of easing at some point because recession risk is rising, well, then perhaps gold is a little bit better supported. And granted, it is, of course, not rallying up a storm here. Certainly the rise in the dollar and the weaker story at the front end of the curve are no doubt helping to keep things anchored, but neither is it falling. And that reinforces, seemingly, this growing recession risk catalyst that is emerging here for investors. With that in mind, let's take a look at the economic data that's likely to shape the story in the week ahead. And we'll start with the global recession piece first. As I mentioned moments ago, we just got a set of PMI numbers out of Europe last week. These are purchasing manager indices that are approximating the trend in GDP, only in a much more timely fashion than GDP numbers themselves. And so you see here in last week's numbers from the Eurozone, from the US, just a range of very disappointing numbers, more confirmation that the Eurozone is probably in recession, and weaker forward-looking growth indications for the US than expected, though the US still a pocket of relative strength. This week, we are going to get that data for the full trifecta out of China. These are going to be official figures. We'll get the Caixin, which is the private sector set of these same numbers a bit later. So the official numbers here, you can see, expected to show that services activity continued to slow. The composite then continued to slow as well, with yet another month of contraction in manufacturing, all of which seems to reinforce the idea that the situation in the world's second largest economy is continuing to deteriorate. If we look at the way Chinese economic data has been performing relative to forecasts, we can see that index is well below zero and doesn't seem to show any real conviction to rebound here. So the possibility still is that Chinese data flow will surprise on the downside. And with that in mind, we get these recession worries amplified. Next, Germany will report its inflation numbers here, the first look at August. And the expectation is that we're going to see inflation cooling down to 6%. Still, obviously, a far way away from the ECB's 2% target, but nevertheless, a move in the right direction and the lowest number yet after we started this disinflation effort last year. And what we see here in the case of Germany is a little bit different than what we see in the US, and perhaps even a little bit different than the rest of the Euro area. Because what we see is essentially that it is core inflation that's holding up. It is headline inflation that's coming in, that most of it is goods, not services. When we look at which part has been the main driver of disinflation or for inflation to come in, that has been actually a fall in gas prices. Because gas prices, despite the war in Ukraine, have actually been tumbling since the war started, ostensibly, and this is our theory here on macro money, that Russia has been flooding the market because it is trying to maintain market share in the few commodities that it can still ship around sanctions, and therefore somehow maintain a level of financing for this war effort and the economy writ large. So, gas prices have been falling, but it seems like the main lingering piece on the good side, which is still dominant, is actually another export from Russia and Ukraine, grains. Here, there is still a degree of resilience. And needless to say, this is not something that the ECB can have a tremendous amount of impact on. This is mainly a global markets kind of thing. So with that in mind, it is unclear that the ECB is going to look at something that's powered by essentially food inflation and say, we need to hurt the economy more to bring this in. And so with the economy already ostensibly in recession, this probably isn't something that gives the ECB reason to get more hawkish. In fact, we can see that since the last ECB meeting in late July, the curve has shifted significantly lower. The markets are expecting the ECB to start to wrap up its rate hike cycle, and we can clearly see that shift in rates all across the curve reflected. In fact, the back end of the curve is a little bit more flatter even than last week. That's the small dashes there. And you can see here that at this point, we still are mostly leaning in the direction of one more hike. There's about a 76% chance that we are going to get it baked into the markets here. You can see that for the December number right here. And as you can see, the probability in terms of when that hike will occur, it's actually still September by a narrow margin. So about a 42% chance that this hike occurs in September, and then by November, the probability is higher, but the chance that it actually occurs then is only to 26%. So the markets are still leaning in the direction of one more hike. There are better than even odds of one, but this has been falling. This was fully baked in not too long ago. And so if these numbers out of Germany are going to suggest that indeed disinflation continues and that the things holding up the price level aren't those things that the ECB thinks it can have near-term impact on, well, then they're probably not going to be too keen, or at least thought of as too keen, to continue to squeeze an already hurting economy. And so the probability of a further hike might fade some more, weighing on the euro, but maybe giving a little bit of lift to local shares. We'll see if that actually materializes. With a global recession narrative afoot, it's the shares part that seems more uncertain, but the weaker euro part that seems more like the likely way forward. The U.S. PCE measure of inflation is on the books as well. This, of course, sets us up for the U.S. portion of this story. There's going to be key numbers this week that bookend the week, and the PCE number actually drops right in between them, so we'll go a bit out of order here. Not surprisingly, you can see goods are now an actual source of disinflation. They're actually, you can see that little yellow bit under zero down here. This is actually telling you that the price of goods is actually undermining inflation at this point. It's actually pulling inflation down. It's services where there is the most inflation to still work down. And just like CPI before it, we can see that we're looking for the PCE index to show that disinflation overall actually stalled in July and that prices ticked higher. So that would, of course, reinforce the sense that the Fed is not contemplating a near-term retreat. Where does inflation come from in the services sector? Well, as we've looked at before, it is seemingly wages. Now, the biggest contributor to PCE inflation at this point is the imputed cost of homeowner-occupied housing. There isn't much that the Fed can do with that. They certainly can't go out there and scream at homeowners to sell. And with mortgage rates as high as they are, but at this point about 7+ percent, meanwhile, the rate on outstanding mortgage debt on average is something like 3.6%. That's from people locking in 30-year mortgages while rates were still low. We are looking at a situation where people are going to be reluctant to sell because they don't want to refinance and buy something with a 7% or more interest rate when they've already locked in one below 4%. That's not a very attractive idea here. We talked about this in our survey of the U.S. housing market last week. So chances are that's not the place where the Fed is going to have impact. The other bit where the Fed does have some agency is the labor market. And here you can see a continued shortage of close to 3 million workers. That's that blue bar bit under zero. That's the difference between labor supply and demand. That's still underpinning wages. And the Fed spent a long time at Jackson Hole and, of course, in previous engagements talking about how where it wants to have impact is the service sector, excluding housing. And that the main focus here is unemployment. That only when unemployment starts to rise would the Fed feel like they're restrictive enough to achieve their inflation goals, because in every past instance that they cite of looking at attempting to disinflate the economy, it's come hand in hand with a pickup in joblessness. So as we look at this inflation data this week, the key numbers are likely to be those that are bookending it. First, the job openings number, which will help to define labor demand. Here we're expected to come down to 9.5 million, which will be the lowest number, as you can see here, in quite some time. Nevertheless, way higher than the pre-pandemic average of about 7 million. And then toward the end of the week, we are going to get the monthly jobs report. And here, we're looking for the economy to add 168,000 jobs to non-farm payrolls. Again, the lowest number in quite a while. In fact, going all the way back to late 2020, where you see that last big negative number there at the far left-hand side of the chart. But nevertheless, a number that doesn't scream collapse, a number that's sort of well within the gradual decline boundaries here that we've seen in monthly job creation. The unemployment rate still seen holding just a hair above historical lows. 3.4% is the historical low. We're expected to hold, or at least the known historical low, as far as my data goes anyway. That's just a hair below where we're expected to come in, unchanged month on month at 3.5%, all of which seemingly speaks to the Fed's greater conviction in continuing to press on with a hawkish stance. We glanced at this earlier. Here it is again, a 65% chance now of rates rising again this year. That's a very dramatic reversal versus the beginning of the month, where that likelihood was only about 20% and change. Cuts now starting later as well. You can see we were flirting with the idea at the beginning of this month that they might begin as soon as March. Now the first rate hike reversal, so the first net cut, seems to be starting to happen in June. The place where we undo any further hike that might happen appears to be March. So you can see here in March, rates are only 18 basis points north of where they are currently, which would imply that if we did get another hike, we'd be starting to have the possibility that that hike would be given away by then. There's a further chance that that happens in May. And you can see the likelihood that there's a cut there is about even, 31% versus 38%, give or take. It's by June that we've certainly seen a cut relative to current levels. You can see that's at this point at 78% chance. We have still almost 4 rate cuts baked in, but now it's closer to 3.5. And the fourth one is now pushed out to 2025. So the outlook has already become a little bit more hawkish. The setup this week seemingly aiming to show us that the Fed is indeed going to follow the data to a more near-term hawkish stance, with other indications of global growth out of the Eurozone and China suggesting that the global recession is nevertheless gathering, all of which stands to give us another repeat performance similar to what we saw last week, only this time we don't have NVIDIA earnings to throw a wrench in the works. So perhaps we're looking at lower shares, and perhaps the moves we've been seeing in gold, in rates, and in the dollar continue. And that is Macro Money for today. We are, as ever, here Monday through Thursday every week right after overtime, a show that I do with head of futures and forex here at Tasty Live, Chris Vecchio. Today we were also joined by the great Thomas Westwater, who gave us his insights as well. We're going to increasingly have guests on the show. Dylan Radigan will be back with us on Wednesday this week for his perspective, so definitely tune in for for that. I am also on with Chris for a Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, opining on the news and insights section of tastylive.com. In fact, there's a summary of this very weekly outlook there right now in written form. And, of course, saying all kinds of things, both pithy and otherwise, on Twitter. Yes, Twitter, at Ilya Spivak. Thanks very much for joining. See you tomorrow.